You are now listening to episode 55 of Count Me In, IMA's podcast about all things affecting the accounting and finance world. I am your host, Adam Larson, and I will be bringing you right up to the conversation between my co-host Mitch and Alessia Falsarone. Alessia joined Count Me In to talk about how and why 2020 is the year of ESG data. She is the head of sustainable investing and portfolio management for PineBridge Investments and has a wealth of knowledge in the area of sustainability and integrated reporting. Let's head over to the main part of our episode now and hear Alessia share her valuable perspectives on ESG data.
What are some typical line items or key data points relating to ESG and sustainability that accountants should really be reporting on?
Well, first of all, thank you, Mitch, for inviting me to share the investor lens with your audience at the IMA today. Now, as you said, 2020 is truly the year of data for ESG, as the entire field, not only investors I'm referring to, but controllers, treasurers, CFOs, auditors, they're all taking a much closer look at what is generated across their organizations as relates to sustainability efforts of the enterprise. And so starting to take stock of the linkages, if any, between sustainability credentials that a company may list for you call it customer outreach or end market awareness in their report and their website versus actually the financially material sustainability factor that affects the profitability of their business. And that is an area where either accountants or treasurer or CFOs are been spending, in my opinion, and with the companies I engage with as an investor, a lot more time since they're really looking at them as a not only an engagement tool, but an alignment with their financial commitments. So where sustainability is adding value in reporting is really in driving that intersection between the sustainability efforts of the enterprise and the value add in terms of financials on an operating efficiency scale or on a top line growth. What's interesting about that is if you're thinking about corporate governance and you're going back to corporate directors surveys, for example, last year, I think it was PwC that found that more than half of directors were saying that investors are giving way too much time and focus to ESG, environmental and social governance considerations, which is nearly twice the percentage that has said the same in 2018. Now, why is it eyebrow lifting for me as an investor and also thinking about the accounting side of business? Because clearly there is the need for continued dialogue. If the board does not recognize the value or the audit committee of the board, then investors need to continue to debate the investment saga or not, but we will see very little value add in corporate reporting initiatives. So when you compare that survey, so at the corporate directors level, to the engagement priorities that institutional investors like ourselves may disclose during the 2020 proxy season, clearly environmental resilience and also the ability of the board to address resilience through capital planning considerations is clear. So as I said, my lens remains biased both as a capital markets professional and as a certified director with NACD, the National Association of Corporate Directors, and I can assure you that there has been a strong push to elevate director skills and skills at the audit committee level to see the relevant disruptions in ESG and how they affect business. And that is something that should be top of mind for the audience at the IMA. ESG is certainly a intangible one on a clock. It carries reputational risk that no sustainability credentialing process could make up for if lost. So again, few enlightened board chairs or audit committee members see that, and they are certainly keeping the accounting for ESG data up the priority list.
So that's really interesting. And, from this investor perspective here, aside from the time and the priority that goes into it, I'm sure there are a number of other challenges as well that, accountants particularly must be aware of. So from your perspective, what are some of these challenges that accountants face with this ESG data when it comes to giving investors the information that they're really looking for?
Yeah, so it's interesting. I think when I look at the perspective of financial innovation, and you're thinking of the headlines surrounding, for example, the issuance of sustainability-linked financial instruments, such as traditional green bonds or loans, or even new instruments that are transition linked. So they are capital raising industry instruments that are connecting to sort of upgrade the operational bent of a company as relates to carbon transition, their businesses. You see that there's definitely raised awareness as treasury teams at a company and CFOs are more involved with auditors and external verifiers in aligning capital raise with CapEx associated with sort of green efforts. But that's just one part of it, right? The raised awareness. When you're thinking about the accounting for the ESG data, the need for ESG data needs to be aligned with financial commitments of a firm, as the data is about really longer term trends that will require as much OPEX as CapEx to build both resilience and, in a way, competitive advantage and top line. So what's the biggest issue that remains that environmental and social governance data and the impact on dollar unit of measures are the hardest to address, as clearly non-financial risks and non-traditional sources of risk don't come in the same unit measure. So clearly now you have, or you're asking accounting and finance professionals themselves to test kilowatt hours when aggregating energy efficiency or metric tons of CO2 per home when discussing home energy use, or even more esoteric unit measures such as near misses, which is the count of events, right, with the potential of loss or injury if the accountant is analyzing health and safety statistics within the workforce. So whose domain is that? And it is increasingly of financial professionals. While there is certainly room to define best practices, it is simply good business management to define environmental, social, and governance indicators at the company level that are associated with financial outcomes and address them and are reported consistently. They could be in the form of trends or statistic absolute levels if there are, for example, absolute targets in place. And I'll give you an example very recently of, for example, a new green cement laboratory in Colombia where they found a way to ensure that green techniques are applied to the production of cement. Now, the production itself is clearly an energy-intensive process. And so while the green aspect of bringing to market a more sustainable product in terms of carbon release in the atmosphere during production may indeed be part of an environmental materiality approach and disclosure that could be externally verified and clearly has financial consequences that are associated with potential carbon levies on that economic activity in the future. Yet the financial relevant aspects to be accounted for are associated with another set of questions. Now, first of all, there is a business materiality that will call for near-term financing from the legacy cement production and what happens to those production tools to newer products, including timing of operating expenses and CapEx that are associated with it. And then you have potential forecasts of market share gains and therefore more stable pickup in free cash flow numbers, including the impact, for example, on credit metrics. So unless we place the financial materiality of, for example, an innovation in the context of how sizable is the opportunity, and when we try to report on the financial benefit associated with, for example, greening products, we may not be fully capturing that in enterprise value. And therefore, there may be no additional incentives for a management team to carry out a full upgrade of their product offerings anytime soon. So the accounting world has a tremendous opportunity to pick up on innovations like the one I just mentioned and find ways to articulate that in a financial outcome and within a reporting time horizon in mind. Now, moving from sustainability credentials, awards, recognition, into a set of variables that are really part of an investor day type of dialogue is really key. And certainly the underwriting of, again, all financial instruments that are addressing the quality of, for example, project financing, have made corporate commitments even more visible globally. So definitely we're in need for properly accounting metrics and corporate governance practices that are both internally and externally verifiable and sort of assurable, if not assured yet. So in a world where boilerplate language is still the norm, it will not be surprising then to our audience today to hear that in the face of boilerplate language and the lack of faster adoption of standards such as the one by the Sustainability Accounting Standards Board, investors do in fact apply their own independent research and opinions to their investee companies. And therefore, they're bridging the gap in between sustainability accounting and financial decisions when looking at the reporting numbers of a company.
So you just touched on a couple of things that I want to circle back to and make sure we address. I know you were talking about financial outcomes and making sure that, the traditional external financial reporting for accountants, we always rely on verification and consistent units of measure. So how does this ESG data really translate, and really what's the difference between integrated reporting with all these challenges compared to the traditional financial reporting that most accountants are familiar with?
Yeah, it's interesting, right? The value of integrated reporting is really more tangible than ever, or is becoming even more tangible when dealing with sustainability factors that affect a business in ways that are certainly not unidimensional, right? And I just given you the example of, for example, a cement production company earlier on. But what I mean by that is going back to the different unit measures and the continued need for comparability. The value of having a solid corporate reporting that incorporates both governance of environmental and social factors in management discussion, for example, and analysis, as well as now entering the foundation of financial commentaries as well, when material, that value is now more than ever a risk of miscommunication or even lack of targeted, so to speak, communication surrounding financial relevant issues that are strategic value to an organization. And for example, you may probably have heard, but the largest study release that I know of zooms in on how 1,000+ companies in Europe disclose information in their financials on their environmental and social risks and impacts. And the EU has been, as we know, at the forefront of regulatory awareness, but also action surrounding standards and reporting initiatives. Now, this study is fresh off the press. It was released yesterday in the US on President's Day by the Alliance for Corporate Transparency. And briefly, the results show that a majority of companies are focused on policies and procedures and commitments with respect to non-financial risks, such as sustainability, but less than 22% or so. So less than 1 in 4 report on them and define performance indicators that are verifiable along with their financials. And 13% or so define business exposures, for example, to polluting sectors. Now, if we delve into issues related to the workforce, the statistics are even more alarming. 80 to 83% describe their human rights policies, but then a fourth disclose the actual risk associated with human capital. Less than 15% report on actual impacts on the business. So when you go back to the same Ernst & Young report that I mentioned on investor engagement priorities for 2020, issues such as human capital and workforce retain top 2 positions along with environmental concerns. And so that is a key strategic success in the next 3 to 5 year term, including issues of workforce diversity and culture in the workplace. Now, traditionally, investors have focused on workforce compensation in their analysis, but in many cases, that is clearly connected to pay equity and promotion rates and so on. It is not a one-size-fits-all approach, clearly. If anything, though, it is highly dependent on the end markets in which a company operates. And so integrated reporting and reporting is shared in general should clearly be aligned with the need for more accurate statistics in that term. Now, I would also encourage the audience to follow, for example, the research process or the project on human capital that the Sustainability Accounting Standards Board has launched in the fourth quarter of 2019. It clearly addresses the need for deeper exploration of dimensions such as, again, human well-being in the workplace, and now the impact of technology and innovation, for example, in upskilling has been capturing the impact of, for example, D&I in terms of its financial materiality. And there are metrics in place where integrating reporting has done a tremendous job in aligning, again, financial commitments with company value. So if you ask me, where do I see the value of integrated reporting going forward, it is a communication toolkit that is very much lacking, which is needed to define management discussion and analysis. more broadly about these issues. Financial reporting and obviously the management oversight of financially material sustainability risk. As an investor, I see strong value in the work of SASB, and clearly that is in my toolkit, and certainly it is under the SASB guidance that increasing investment analysis are performed pre and post due diligence for both public and private entities.
And I think that's all great, and thank you for clarifying all that information. You did just recently mention something about technology and upskilling, though. So I would like to get your opinion on what you have seen in the market as far as how technology has impacted this integrated reporting, and what does that really mean for the accurate data that investors are really looking for when it comes to integrated reporting or financial reporting in general.
Yeah, that's a really key point. Clearly, we need to recognize that technology has affected the entire financial services and business management industries in general for about 2 decades. And going forward, I see certainly technological innovation adding in 2 key ways, right? One is through enhanced verification and assurance, as you were pointing out, and the other directly in incorporating non-traditional sources of sustainability-oriented data feeds into financial analysis. Now, we're thinking about the first application, right, the enhanced verification and assurance process. Clearly, the vast number of data points with consistent history and verifiable sources of information that are available today has created the best backdrop and the best tailwind to harness use cases of all the alternative data and non-traditionally collected data, nor traditionally accounted for data series that in aggregate enable decision useful content in the reporting of outcomes. As an example that comes to mind for me is the emerging use of geospatial data or Earth observation through remote sensing technology for the analysis, for example, of environmental risks in supply chain. It is clear to me that such applications will become core in financial reporting related, for example, to enterprise risk management and scenario planning under the TCFD reporting. Now, the second leverage point of technology innovation in accounting and reporting applications, so to speak, is clearly the translation of non-financial data into financial metrics. And the real need is to ensure that whatever vendor is selected or in-house built platform is rolled out, it is conducted from a place that truly looks at the ultimate use of data as monetary liabilities associated with the mismanagement of that information collected, and how much that information is actually a verifiable process to derive financially material decisions for a business, as it may also be subject to cyber and broader reputation risk, even if it comes in non-financial unit measures and may look harmless. So if we think of medical records, for example, and privacy, it's easier to see the case for heightened vendor management practices surrounding the use of technology. As an anecdotal evidence, I've heard that in between 700 to 800 data fields are available regarding environmental and social governance practices of an organization. Now, without accounting for the severity of impact or the likelihood and other measures that address validation of the ultimate source of the data point, that may be not financially material data at all. So the role of the Big Four, for example, in building not just reporting, but also growing the existing advisory business into sustainability services for management team, speaks to the need for well-rounded due diligence on the data and the data collection side. Now, an area where I believe technology will become increasingly relevant is, as we talked about before, the third-party verification of impact, which is yet to be addressed and likely a crucial aspect in a world where really companies are setting bold climate science aligned targets for carbon emissions, and they're starting discussing variables such as scope 3 emissions, which are not measurable as part of any operational framework, but go outside of the company. It's use-based side of their products, follow the products and their services once they leave the showroom of the shelf, so to speak. So I'm a big proponent for that respect of blockchain solutions. I've heard the digital ledger defined for a long time as the hammer looking for nails. So sustainability may as well need a perfect nail for blockchain and digital ledger technology. Now, if there is one thing I will leave the IMA audience with today is sort of the following questions. Ask yourself whether XYZ, and again, identify the most pressing ESG issue that your company is facing and the company you are reporting for or analyzing is facing, and whether in-house there exists a collection point where that data can be streamed, which processes it currently informed and can be verified, and take charge of its integrity, and how many times the data point has been presented to the management team of the board audit committee. So if you just start with that, you will already be on your sustainability reporting journey.
This has been Count Me In, IMA's podcast, providing you with the latest perspectives of thought leaders from the accounting and finance profession. If you like what you heard and you'd like to be counted in for more relevant accounting and finance education, visit IMA's website at www.imanet.org.